Hello, everybody. Welcome to Monday. The S&P 500 was down 1.5% today. Really started off the morning with the concerns about what was happening in China with the protests over the zero COVID lockdowns. Obviously, China is sort of the supply chain of the world, and the less, that's coming out of there, the more, problems we're going to have with inflation, especially for those goods. And one of the weird ironies is that oil actually dropped today, which actually eases inflation, just because if China's not making goods, they're not using as much energy to make those. So it's one of the reasons why we saw that happen today. So very interesting to see how that plays out. We'll keep talking about that as it comes. It's difficult to see, what the solutions are to the problems that they have there and how that might affect, their manufacturing capabilities as far as that goes. Second largest, economy in the world, definitely something we have to pay attention to. But the market really kind of continued its downward trend with the different interviews that were happening from the Fed governors and ex-Fed governors. There are quite a few today. They, again, want to contain the stock market. It helps them to fight inflation, to have the stock market stay down. So most of their wording was quite aggressive because the market's had such a nice run since the middle of October, talking about the raising of rates and how long they're going to keep it up there and those types of things. However, they can only move the market so much with their words. Really, if you look at what happened to the bond market today, I think you'll see something completely different. So the yield on the 2-year Treasury today didn't move, and it's actually off of its high a fair amount from where it was a couple of weeks ago. And what that's showing you is kind of a projection from the bond market for where interest rates might be going. And one of the things I really do focus on here is that 2-year yield. What you'll normally see in a market like this is that the bond market will kind of bottom out, which means the yields would peak out before the stock market takes off. So the bond market has been more accurate, than the Fed as to where their interest rates are going to go. So I definitely would pay attention to that. And the bond market has been quite accurate at figuring out where the stock market might go. For example, the yield peak on the 2-year Treasury lines up roughly with the bottom of the market here in October for this particular run. So if the bond market is not moving up, I wouldn't be as concerned about these types of down days that we're having today. So let's see what happens there and see how that plays out. Of course, we have the next CPI report coming out on December 13th. And that last time we had the report, the market jumped 5% because it came out to be a decent number. The expectations is that this report would be better than the last report. So there's still some, motion here. And I think that's why you're not seeing the bond market react the way you're seeing the stock market react today. So let's see how this plays out. Look forward to talking to you tomorrow. Thank you very much.